Hi, today I'm going to discuss about the Buffett Indicator, which is one of the tool or expression that is used to value stock markets. Buffett Indicator is an indicator to measure the valuations. It was introduced by Warren Buffett in 2001, and it is probably the best single measure of where valuations stand at any given moment. So, if we look on to the calculations of Buffett Indicator, it is calculated by dividing the total market capitalization of all publicly traded companies to the country's GDP. So, it is the recent quarterly estimate of gross domestic product. So, why does it matter? The Buffett Indicator expresses the value of the stock market in terms of the size of the country's economy. So, if the stock market value is growing much faster than the actual economy, then it may be in a bubble. So, on calculating this, if the percentage is 70 to 80%, then buying the stocks is good as it is undervalued. And if the percentage is 200%, then the markets are overvalued and it's very bad to buy. So in one of the speeches of Warren Buffett, he explained about the scenario of stock market and the relation to the gross domestic product. So from 1900 to 1921, the Dow went from 66 to 71 in 20 years, and from 1921 to 1929, Dow went from 71 to 381, which is about 500% increase. Then from 1929 to 1948, Dow went from 381 to 180, so it was cut in half here. Per capita GDP was moving up during this whole period and economy was doing fine, but the stock market went from 381 to 180, which was a huge fall, which was reflecting the previous period of the GDP. So from 1948 to 1965, it went from 180 to 1000, which increased further, and from 65 to 81 it went down again. So it's based on the relation of GDP and stock market, which was explained by Buffett. And Warren Buffett wrote an article in 1979. He explained about the pension funds and their investments in stock markets. Pension funds in 1970 put more than 100% of their new money in stock markets because they were wild about stock, and when they got cheaper, they put their record low of 9% of their net new money in 1978 when the stock got cheaper. So this explains the famous lines that people get excited when others get excited, they get greedy when others get greedy, and they get fearful when others get fearful.